Good afternoon. Good afternoon. Welcome to another edition of Monday Market Picks. It's Monday, the 28th of April, and my name is Thilan Wickramasinghe, the head of research for Maybank Securities here in Singapore. Asian markets are trading cautiously, with Singapore losing some steam today. And this is the world we are living in right now. You've got a thick fog of uncertainty around US policy, and that's driving the direction of markets or the in direction of markets in a way. Trump is saying that he will not extend his tariff reprieve more than what he has done. So that's going to drive even more uncertainty in the markets in the coming days. So where do we hide? We actually think Singapore offers an interesting defensive place to hide, and we'll explore why in this show today. We'll also drive a lot more deeper into one of those stocks that we're going to talk about, which is Raffles Medical, and we have Eric Ong joining us to take us through why he upgraded his target price there. Then we have Husseini, who's joining us to preview the results that we should be expecting from C as well as Grab over the next few days. And we also have our chart guy, Amirul, with two brand new trading ideas as well. But let's start with Singapore. Now, from what was unleashed 3 weeks ago from the Rose Garden, the list of unknowns keep growing, and it's unlikely to abate anytime soon by the looks of it. We think Singapore's large trade dependency, around 300% of its GDP, is not going to spare it. But a lot of things are happening domestically that it might actually provide some cushioning to the worst of the impacts. The domestic economy is gaining some bandwidth. First, there's a construction boom. We've seen massive mega projects being announced from Changi T5 to Tuas Port, also public construction of new HDB flats and so on. The first 2 months, that's all the data we have, which is up to February this year. Construction contracts have surged 58% year on year. We also had an election budget with a lot of generous transfers from the government, and the government still has fiscal capacity of about 14 billion Sing dollars that they can draw down this year and provide additional stimulus if needed. Third, as we have seen during times of extreme stress, the government has a track record of delivering extra stimulus through the budget, as well as through dipping into past reserves as well. We saw that during the GFC. The government increased direct stimulus to about 7.6% of GDP. Plus, they also provided about another 1.5% of GDP of stimulus by dipping into reserves. Now, when we think about COVID, the government actually provided about 14.4% of direct stimulus and also another 8% of stimulus from drawing from past reserves as well. So there is quite a bit of cushioning and firepower that Singapore has domestically to cushion some of the worst excesses of the global uncertainty that we are living through right now. So this may actually attract safe haven flows into the Singapore market, given that there is better clarity in terms of policy here versus policy in the US. And certainly policy in Europe and China as well to actually to extend that argument. Now, one of the things that we have done is to play this domestic resilience theme. We've done a screen across all SGX names, both the companies that we cover as well as the companies we don't cover, and look at companies that derive more than 50% of their revenues from Singapore. And we've limited, we've put a cutoff of 400 million market cap, so that at least we're looking at much more larger companies and mid-cap companies. We've also excluded the banks, as while they book their revenues in Singapore, they are far more geared towards a global trade cycle. So we've taken them out as well. But even with that, we end up with about 40 names. Half of them are REITs and real estate. Now, this actually dovetails very well with a positive view on the REIT sector. And Krishna was on the show last week talking about why he thinks that the sector, he is quite positive on the sector, as well as some sensitivity analysis as well. Now, some of the names that pop up that we like and we actually have coverage on are names like CICT, FCT, KREIT, as well as Impact. We also have seen a few property developers and construction names and related services as well. So names like Bukit Sembawang, BRC Asia, Wing Tai, and OUE. Now, the industrials and the utilities name was also feature quite well in our list. There's a lot of them with domestic utilities contracts, as well as order books that are executing domestically as well. So Semcorp and Keppel are some of the larger names there. We also have some of the consumer and healthcare names that will benefit, including Shenxiong, Kimley, Raffles Medical, Thomson Medical, as well as TalkMed, which is a smaller name. Now, finally, we also see transport names as well, like Comfort, Delgro, SBS, Transit, Viacom, as well as media stock, which is StarHub, also coming up in the list. It's a very, very comprehensive list, so do take your time to go through our report, and you'll see all 40 names. And we think that Singapore will provide some safe haven protection, as well as it'll attract safe haven flows from investors as this uncertainty around tariffs and trade flows and US-China all play out for the next few months. Now, having said that, I want to drill down on one specific name there, which is Raffles Medical. And this is a stock that actually screens very well as a local champion as well. Now, I'm going to bring in Eric here. Eric, welcome to the show. You've actually raised the target price of Raffles Medical to $1.13 on potential upside from their international exposure. So can you tell us what you're seeing there?
Hi, Tilan. Thanks for having me. Earlier this month, Raffles Medical signed an agreement with the affiliate of Shanghai Jiao Tong University School of Medicine to work on a new model of collaboration between public hospitals and international medical group like Raffles. So essentially, they will share resources and joint market development, especially in areas such as cross-border telemedicine consultation. Meanwhile, we understand that the Group 3 China hospital looks set to remain their positive trajectory in terms of patient volumes and revenue as due to increased service offering and marketing efforts. Shanghai, in particular, have seen steady growth in FY24, given its partnership with insurance companies and corporations to offer tailored healthcare packages. So overall, Raffles is still optimistic about their opportunity in the country, given its growing brand recognition, and management is expecting its China operation to achieve EBITDA break even by end of FY26 as it continues to ramp up its bed utilization there.
Okay. Now, since we're talking about domestic champions as well, and this name screens pretty well for the domestic champions, how much of their domestic business do you think is shielded from all this uncertainty globally?
Yeah, last year, over 90% of their revenue still came from Singapore, out of which about 34% was contributed by its GP services, then 40% from its hospital services, and the rest from insurance income. In Singapore, we understand that Raffles is now focusing on growing its existing primary, secondary, and tertiary care businesses and improving its operating margins. So new initiatives may include expanding its telemedicine service, as well as repositioning some of its existing service to respond to the market interest for wellness. It also provides step-down care services for the MOH to help relieve the bed shortages at public hospitals. So I think overall, these are largely non-discretionary and comes with domestic demand resilience, and we are therefore keeping our forecast intact.
Got it, got it. And in the sort of near to medium term, what catalysts are you looking for the stock?
Yeah, since its February announcement to buy back up to 100 million shares over the next 2 years, Raffles has so far acquired 7.7 million shares in the open market at an average cost of near 98 cents. This ongoing share buyback should help to buffer any price weaknesses, as well as further optimize the group capital structure, improve ROE, and achieve EPS accretion. Other re-rating catalysts may include higher than expected dividends and earnings growth, as well as faster turnaround of its China operations.
Got it. Thanks, Eric. Now, before I go to Amirul, who's going to talk us through his new technical analysis. I've got a question from the audience here who says, given that banks are excluded due to their global trade cycle linkage, are there any other FIs, financial institutions with a strong domestic focus to consider? Yeah, so I mean, I think we excluded the banks because even though, as I said, they do book revenue in Singapore, they do a lot of trade loans. They derive a lot of fees from trade, so they're going to have a much more higher volatility to the global trade cycle. We do highlight three names in the list that are domestic financial institutions, which is Hong Leong Finance, iFast, and UOBK HIAN. We think these names are a lot more resilient. Hong Leong Finance caters more towards domestic SMEs, and we think that especially with the construction boom, there will be requirements for more financing for construction equipment and things like that. So that's something that Hong Leong Finance will benefit from. And the two brokerage and financial firms, iFast and UOBK HIAN, should benefit from domestic brokerage uplifts if you do have more safe haven flows coming into Singapore, as well as ancillary services such as increased demand for deals and things like that in Singapore, particularly given the fact that you also have this push by MAS to make Singapore's market great again as well. So quite a few drivers there for some of the more domestic-oriented financial companies that the larger banks may not offer. Now, with that, let's move to Amirul. Amirul, welcome to the show.
Hi, Dylan. Thanks for having me. Good afternoon, everyone. So let me just share my screen first. Can find it. All right, so I hope you all can see my screen right now. So before I go into our two technical calls today, so I'll just like to take a quick look on the Straits Times Index first. So as if you look at the chart over here, we know that it has recently been in a sharp bullish momentum right over here, right? So which means despite this current sharp correction post tariff liberation day, the overall primary trend remains in an uptrend because the price managed to find a strong support at its uptrend line over here. So today it went through a mild pullback, but it managed to maintain its position above this orange line over here, which is the 50-day EMA. But then in order for the uptrend to be confirmed, you could see that this blue line over here, which is the 21-day EMA, has to cross above this orange line, which will allow the MACD to return to a positive reading. That's when the primary uptrend could really be confirmed. But then overall, despite this recent pullback, we believe the bullish scenario could actually be happening despite this recent pullback, as long the index maintained above this blue line, which is the 21-day EMA line. So that's it on the quick outlook on the index. So before we go to our technical call, I would just like to go through the chart of the day, which is the Sing post over here. This is not a buy call, just a recommendation for all of you to look at. So if you look at the chart over here, despite the pullback from today's session, Singpost managed to maintain resilient, right? So if you look over the chart over here, it managed to find a strong support from its uptrend line. And we could see that the 21-day EMA over here managed to cross above its 50-day EMA, which means that primary uptrend remain intact and possibly this bullish momentum could actually continue. If you look at the MACD reading, it is now touching the positive reading. And if you look at the RSI, it is rising slowly and steadily, but it is still way below its overbought level, which means the buying momentum could remain elevated in the short term. So let's go to our two technical call today. Just now, Dylan has recommended UOBK HIAN. So basically, it would also be our technical buy call as well. So if you look at the chart over here, the primary uptrend remain resilient as it found strong support from this purple line over here, which is the 200-day EMA. So you can see price has rebounded and now it has broken above all its moving average line. So recently it has just completed a bullish formation, which is the bullish flag pattern. So despite its pullback today, the price managed to maintain its downtrend line. So basically, this bullish flag momentum remains elevated. We anticipate that this primary uptrend could actually go further because this 21-day EMA has just broken above its 50-day EMA, and price is now consolidating right around its 38.2% Fibonacci retracement level. So if I just draw a line from this low up to its peak, so you can see price is now building, is consolidating right above this line. So if as long price maintains above this 38.2% Fibonacci retracement level right around its 1.76 or 1.77, we believe this primary uptrend could actually continue. And lastly, let's go through our next technical buy call, which is EAM Holdings. So if you look at the chart over here, recently we have actually made a sell call for this counter because it is nearing its support line. You can see the price has broken below its double top pattern, but then it already hit our target price. So given the recent consolidation, we believe its recent sell-off has bottomed out right around SGD 1.00. You could see price has broken above this rectangle pattern and now trading back above its 21-day EMA line. It is now testing its this strong resistance line, and if price can break above this line, we believe this bullish reversal could actually continue because it might also break above its 50-day EMA line. We believe this scenario is likely given that the RSI has rose from the oversold territory. Now it is consolidating right around the 50 level, which means that bullish momentum is strong, getting stronger. And if you look at the DMI reading, it has turned positive, which means that its bearish sentiment has slowed and now it is turning into a bullish reversal momentum. So that's all for me today. Over back to you, Dylan.
Okay, thanks, Amirul. SMong, on your support resistance price, instead of just letting us know the Fibonacci on the technicals, we will have a look at that for the next show. Okay, Hussaini on the line to talk about ASEAN Internet. Hussaini, we published the first quarter results preview for both C and Grab, and C is your top pick. So let's start there. What can we expect?
Sure. Thanks, Dylan. So for C, we expect a strong momentum of 2024 to sustain into the first quarter of this year. Overall, we expect revenues to grow 32% year on year and adjusted EBITDA to grow 83% year on year. We see a trifecta of double-digit growth across its business segments, i.e. Shopee, Garena, and digital financial services. For Shopee, we expect 19% GMV growth in the first quarter. Some quarter-on-quarter softness in the Shopee business is expected in quarter four, which is expected in first quarter because fourth quarter typically is a very strong quarter. Now, that said, we see 25% year-on-year increase in quarter-on-quarter increase in adjusted EBITDA, as there are various monetization initiatives are in place. Our adjusted EBITDA estimates for the first quarter is 14% ahead of street. Now, maybe one last point to note is the one catalyst to keep an eye is the Garena Free City. This is the major new game launched by Garena, and it is built in-house. So keep an eye on it. The initial reviews of this game are very good. So we remain quite hopeful on the success of this game.
Okay, great. And how about Grab? I noticed that the last 5 days of trading, the stock's up close to about 16% or so. What are you expecting for Grab?
So for Grab, we expect a similarly strong first quarter with GMV to grow 15% year on year, revenues 19%, and adjusted EBITDA by 57%. Quarter on quarter seasonality is more pronounced for Grab, and as such, we expect GMV to decline by 3% quarter on quarter. Now, that said, we should see a strong recovery in second quarter. One key thing to note on Grab is that we expect incentives to grow at a softer clip or at a lower clip compared to GMV growth. So on a quarter-on-quarter basis, we expect incentives to decline 10% compared to 3% decline for GMV. And this incentive decline should be seen very positively, as in fourth quarter incentives grew at a faster clip, and that was a major investor concern. So that investor concern should abate in the first quarter with a slower incentive increase. Now, as you mentioned, that the stock has increased 16% in the last few sessions. Note that the potential Grab and Gojek merger or GoTo tie-up remains high on investor radar. And one interesting thing to note is that both the companies are reporting on the same day. So I had been getting some investor questions that why they had been reporting on the same day and things like that. So that also remains one of the area to keep an eye on.
Got it. So key could be a key catalyst. So watch out for that. And well, Hussein, just very quickly, I mean, we can't ignore the tariff war. Now, if this actually escalates, how bad could things get for these stocks? Have you done any sensitivities on this?
Yeah, sure. So first of all, these companies, both C and Grab, have almost zero US exposure. So they won't be directly impacted. Now, if the macro slows in the wake of tariff war, then we should see some impact. Admittedly, these companies are very young, and as such, we don't see or we don't have the precedent of how a macro slowdown impact them. What we have done is that we have run a worst case scenario wherein we have assumed a 1/5 cut in their growth assumptions and a pause in monetization initiatives. So in a worst case scenario, we see around 12 to 24% cut in their adjusted EBITDA assumptions, and assuming that the valuation of this companies hit the trough valuation of the last valuation cycle of 2022-2023, then we see around 40% share price decline for C and around 16% for Grab. Now, I have to admit that this is a worst case scenario. We don't see that kind of impact. We only see a mild impact. And more importantly, both the companies have maintained or noted that they haven't seen any slowdown so far in the wake of this tariff uncertainties and things like that.
Got it. Thanks, Hussein. It's always good to have the worst case scenario in your back pocket in markets like this. With that, let's just quickly jump on to upcoming events. It's all going to be results over the next few weeks. We still have a few. We have still a few more REIT results to come through. CapitaLand, Ascendas, Ascot Trust, and so on. We've got Wilmar reporting tomorrow. It'll give us a glimpse in terms of what sort of demand conditions are existing in China. So watch out for that. We also have CapitaLand Investment out on the 30th, and Mapletree Industrial Trust also out on the 30th. With that, we are out of time. Thank you so much for joining us today, and appreciate your support as always. And we'll see you next week. Have a profitable trading week.